There are those who predicted the first market drop that started in the beginning of the year 2000, a year in advance, and the second drop in 2007. How did they do it? There are a couple different answers here, but the first has to do with a price-to-earning ratios. Many of you may know that every stock has a price-to-earning ratio. It's simply the price per share divided by the earnings per share. Another term for earnings is corporate profit. The price in any healthy company is going to be a multiple of the earnings per share. If a stock were selling for $1 per share and the company was earning $1 per share a year, then it would be a steal. You could buy stocks and get all your money back within 1 year. Everything else would be gravy. But the question becomes, what is the right multiple, and how do we know when the multiple is too high, representing an overblown or overcooked stock? And how do we know when it's too low, representing a good buying opportunity? Well, as it turns out, the stock market as a whole has a price-to-earnings ratio. We've always heard that the average price-to-earnings ratio over the long run, for let's say the Standard & Poor's 500 index, which is a compilation of 500 of America's largest companies, is about 15. That means for every dollar of corporate earnings in the S&P 500 index, the price is $15 on average. In my extensive studies of market history and these predictable and repeatable secular market cycles, we found that at the end of every bull market, price-to-earning ratios got near or over 30. In the late 1990s, they were almost 40. That signals a point where the price of a stock is simply too high relative to how much annual profit these companies are making. Think of it this way. If you owned a business, for example, an ice cream parlor, that made $100,000 a year profit, would you sell it for $3 million? Which is a price-to-earnings ratio of about 30. Well, most of you are probably nodding firmly that you would, because in essence, you could take that $3 million and in a normal time, invest it in CDs or government bonds at a little over 3% interest and get the same $100,000 a year profit without ever having to serve a single scoop of ice cream. Intuitively, you know that price-to-earnings ratio of 30 is too high. In the late 1990s, price-to-earning ratios were near 40, meaning we were about to flip into the next bear market cycle. Conversely, I don't believe we've ever recovered from that secular bear market until price-to-earnings ratios get into the single digits. Specifically, they're oftentimes in the range of 6 to 8. So how did anyone know in 2007 that we're due for a second drop? Well, by 2007, the PE ratios had not gotten down to the single digits. They were still in the mid to upper teens. This signaled that there were more time left in the current bear market. Also, by October 2007, the market had gotten up to a previous high that actually slightly exceeded the previous high. That, coupled with the fact that every bear market has had 3 or more major drops, made it appear obvious to those that follow history that that was going to signal the beginning of the second drop. So simple financial ratios like the price-to-earning ratio can be a telltale sign about when we're ready to transition from one secular market cycle to a different type of secular market cycle. But that's something that's mathematical, and let's face it, many people do not like mathematics. So let me explain another less mathematical reason why these cycles have been so predictable and so repeatable throughout history. Do you know at what age people typically get serious about their retirement savings? As much as I'd like to say it's in their 20s and 30s, the reality is that most people don't get serious about their retirement investments until their late 40s or even early 50s. So do you know what average life expectancies are today? For the most part, early mid 80s. So people are serious as a general rule about their retirement investments for only about the last 35 years of their life. Now, how long, if you remember from our last video, does it take for the market to go full cycle? In other words, if you took a 20-year or so bear market and combined it with an adjacent, slightly shorter bull market, how many years is that? The answer is about 35 years. I strongly believe that these two are not coincidental. Think back to when your children were young. You might remember saying something similar to the following. Johnny, Mom and Dad are just trying to give you advice because we've made most of the mistakes that people can make. We want to make your life easier and better. And that's why we try to give you advice. By following our advice, you can actually avoid many of the mistakes that Mom and Dad have made. And you tell me that worked 100% of the time? Am I correct? Of course not. The reason is because of how the human being is generally learns lessons. Human beings learn lessons by making their own mistakes. That's true with our children, and that's true with us as investors. So which mistakes here specifically am I speaking of? Well, the mistake of letting greed take over during the good times and create speculative asset bubbles by driving the prices of stocks up to highs which they never should have attained. Again, every generation has to have, at some point, this period of greed where asset prices get overblown and then everything comes crashing down. In fact, this human condition of creating speculative asset bubbles goes all the way back to the 16th century with the story of the tulip mania for the Dutch, when people speculated on tulips and drove the price of tulips up to ridiculous highs only to have the price come back down and the flowers to be utterly worthless. So there you have two different rationales for why these cycles are so predictable and repeatable throughout history, and also how to know the drops are coming. The first one is more of a left brain mathematical rationale, and the second is more of a right brain subjective rationale. So what can you do about it if we have 6 to 10 more years of a bear market with another major drop around the corner? Well, the answer is simple. The first thing you need to know is that buy and hold doesn't work in a secular bear market. Buy and hold works great in a secular bull market, but in a secular bear market, it just relegates you to a long roller coaster ride with a net of a zero growth. So there are two options that remain. The first is to do what's called tactical allocation. Tactical allocation is where a manager is willing to make wholesale moves into and out of the market to take advantage of the cyclical bull market and cyclical bear markets within a secular bear market cycle. Most financial advisors and almost all mutual funds do not utilize this because they might have a hard time justifying their fees while investors are sitting heavily in cash. Now granted, this type of management can be risky if not done properly. But my point is simply that traditional strategic asset management, i.e. moving money from stock in one sector to another, is unlikely to work in a secular bear market. The second way to make money, of course, in a secular bear market is to stay out of the market and invest in not for growth, but for income. When you cross your fingers and toes hoping for capital appreciation or growth, sometimes it turns into depreciation and shrinkage of values. But investing for interest or dividends is like the bird in the hand approach. If you retire and need the income, you can take it. And if not, you can reinvest it to grow your money the old-fashioned way, organically. There are a number of traditional investment vehicles that have existed for a very long time that investors lost sight of in the 80s and 90s, the best bull market in history. When we as a country became addicted to the stock market, now we are at a time where getting back to the basics with these types of strategies is becoming more and more popular. Stay tuned for our next video, especially if you're thinking that this might be the first time in history that the market is going to recover after only 14 years and also recover without a third major drop. In other words, if you're thinking that the market may now set 2 Guinness Books of World Records, tune into our next video. I'm going to discuss exactly why these cycles have been so predictable and repeatable throughout history, and why I feel firmly that will never change but continue into the future.